Thank you and welcome. As you've been told, my name is Hilary Mulindi. I'll be presenting this paper, which I co-authored with my colleague, Samuel Tiriongo. So basically, we are looking at digital finance and credit access perspective, and we'll be doing a comparative analysis of scenario in Kenya and Rwanda so that we see which areas is Rwanda strong and which areas is Kenya strong, and what lessons can we pick so that both markets can be able to move forward. So in doing so, I'll start by giving the background and context to this study, and then I'll follow up with the research questions, the approach we used in carrying out the study, and then I'll give a high level of the results and finding, and then possibly share some actionable insights from this study. So as a background, all of us know that access to credit is essential for economic development. This one cannot be understated because several studies have been able to bring this out. And we know in each and every economy, the key driver is MSME. And in 2017, IFC was able to establish that MSME represent about 90% of businesses globally, and these MSMEs are able to create more than 50% of employment opportunities. However, these MSMEs have a challenge of accessing to funds. And the problem is even worse in sub-Saharan Africa, whereby these MSMEs are limited by the ability to be able to provide the required collateral, the distance between the MSME and the financial institution that they'll be able to get the facilitation, and then the issue of irregular income and limited knowledge about digital literacy. So based on this, we are now asking ourselves, does digital financial services offer a silver lining to be able to unlock the ability of MSMEs in these economies to be able to access credit? So to be able to contextualize this in Kenya and Rwanda, would like to indicate that from history, we all know that Kenya has been known as a pioneer in digital finance. And way back in 2007, when M-Pesa was coming on board, we had so many people opening M-Pesa agent shops whereby various consumers would be able to access. So between 2007 and 2015, which is an 8-year gap, the distance between a consumer and a financial agent, which we call the M-Pesa shop, the distance was able to reduce from 9.2 kilometers to 1.4 kilometers. At this particular point, if you go to Kenya, every door there's a financial agent, either from M-Pesa or Airtel. So that distance is even much, much smaller than what is here. And another development that you can be able to see, in the recent past, we've been able to see so many digital credit providers coming up in Kenya, and we've been started seeing this mutual collaboration and competition in the banking sector. And the Central Bank of Kenya has been able to come very fast. It's come up with regulation to be able to control these activities. The government on its part is not lagged behind. I know you've heard about the Hustler Fund, which is more or less a digital platform by the government, whereby they're able to extend credit to MSMEs and individuals in the economy. So we've also seen similar trends in Rwanda, whereby the focus has been more on regulatory framework, interoperability, and data protection. And the consensus between Kenya and Rwanda is the significant effort which has taken place to be able to elevate digital finance so that credit access can be something of the past. So in this study, basically, what motivated us is the gap in terms of credit access. Despite regulatory and policy developments in both Kenya and Rwanda, the available data significantly shows some gap in terms of access. So on that basis, we sought to ask ourselves, does fintech, through digital finance, carry a silver lining to provide an anchor for long-term sustainable growth to access of credit by these MSMEs? So basically, that's all about this study, and that's what motivated us to do this. So these charts that you'll be able to see here, they are simply showing those gaps that we've been able to see despite the various interventions by governments in Kenya and governments in Rwanda. So basically, I'll break the research questions into two. So the first research question that we sought to answer is, to what extent does the usage of fintech innovation influence access to credit in Kenya and Rwanda? And our second question in this study was, are there significant differences in the impact of fintech innovations on credit access between Kenya and Rwanda. So basically, at the end of this session, we should have been able to answer those two questions. In our process of answering this question, we first of all began by undertaking an intensive literature review where we looked at various theoretical and empirical underpinnings. And based on that survey of literature, we were able to identify key variables that actually influence credit access. And then we went ahead to identify the most relevant data to be able to undertake the study. So in this context, in Rwanda, we were able to use the FinScope data, while in Kenya, we were limited to the FinAccess data, which is the equivalent to FinScope in Rwanda. On the analytical approach, we had the dependent variable as access to credit, and then we had the independent variables, the explanatory variables, which determine the extent to which an MSME is able to access this credit. But now we realize that not all MSMEs are in need of that credit. So there are three scenarios that arise. There are those who will not apply for credit. There are those who will apply for credit, and the application will get approved. There are those who will apply, and the application will be declined. So because of that three scenario of the dependent variable, we opted to use the multinomial logistic regression, and that was the anchor of our methodological approach. So quickly into findings, but before I go into findings, I would like to indicate that we were looking at credit access as determined by the use of financial fintech services. And then we also looked at how demographic information, such as the age, the income level, the region where the MSME is based, is able to influence whether they'll be able to access or not access. So in terms of fintech usage, we find an interesting result. In Kenya, fintech usage is positively associated with credit approval as a measure of credit access. But in Rwanda, we find a contradicting results whereby fintech usage does not significantly improve credit access for those using it for utility payments and business and financial transactions. And in fact, when that credit access, the denial to get up, the decline on credit application, when we assess it further against fintech usage, we find that the use of fintech increases the probability of rejection of loan application. And that led us to ask ourselves one interesting question. Does fintech usage in Rwanda create a burden for borrowers to be able to demonstrate their credit worthiness? But we also note that Kenya and Rwanda, they are two different economies. They are bound by different regulations. The approval process are different. And then we had the time discrepancy whereby in Rwanda we use the 2020 data, while in Kenya we use the 2024 data. So that could possibly explain the discrepancy between the two results in terms of the impact of fintech usage on credit access. Now, when it comes to the second aspect of income source, so we find that income source is a strong predictor of credit approvals in Rwanda. And what was even more interesting, individuals who are drawing their income from formal sector, that is mainly formal employment, they are more likely to obtain credit approvals as opposed to those who are getting it from informal employment. When it comes to education level, also a positive relationship between the level of education and approval was established in Rwanda, but in Kenya, that was not the case. In terms of regional divide, households in urban areas in Kenya enjoy better loan approvals than their counterparts in rural areas. Of course, in Kenya, what we know, in urban areas, the infrastructure is more developed, and most of the people in urban areas, they are more informed and they are more technologically savvy. So that explains it why we have more approval in urban areas. But in Rwanda, there was no significant difference in terms of region on access to credit. So in terms of age, we noticed that when an individual or the enterprise owner is between 30 and 44 years, the chance of that credit being approved in Kenya is higher. Of course, that one is self-explanatory. Mostly people between that age bracket, they tend to have active employment and they tend to have stable income. So that is more or less straightforward. However, age plays a critical role in influencing the rejection probability in Rwanda. So in terms of, based on the results, we had some significant questions that we asked ourselves. And one of the things we asked ourselves is, why is it that we have these discrepancies between Rwanda and Kenya? What could be done to be able to bridge the gap? Or what lessons can we act on so that at the end of the day, we can be able to increase access to this digital credit in Rwanda? So basically, we narrowed down to 3 things. One of them is on credit scoring, because before any approval is granted on any credit, the risk profile of the individual or the enterprise is very key. So the question that came up is it that the score that the bureaus are having, or the model that they use to generate the score, is not aligned with what the digital credit providers are looking at? So that's why we actually recommending we expand and integrate the credit information sharing mechanism so that beyond the traditional data, we onboard alternative data and make it more informative so that at the end of the day, the credit provider has more information about the borrower. Then the second aspect is on consumer protection. I know there's a site on the Central Bank of Rwanda on the cost of credit, but our recommendation would be that's a good benchmark. It would be more prudent to see what Kenya and South Africa are doing on their cost of credit computation, because what you have is a data at a particular point, but it would be important for any consumer to see what components build up into this score, so that at the end of the day, I can be able to track as a credit consumer. I ask myself, am I getting this high? I'm getting this interest rate, let's say 15%. What are the main drivers of this 15%? What components are actually building up to this 15%? And then let it be like you have 3 or 4 time periods so that I can be able to compare and see, there are these alternative providers of credit. Are they offering at the same rate? Or are there discrepancies, and where are there discrepancies? And then the other aspect that would be very critical is, most of the time when you apply for credit as a consumer, you don't get feedback as to why your credit application was declined. So an aspect of establishing a feedback loop would be critical for the MSME to be able to access credit. And then finally, on product suitability to the consumers. So basically, under this point, to what extent that the regulatory environment support development of products which will be customized to the consumers. And in this case scenario, I would challenge the digital or the fintech solutions. Have you focused on providing individualized products, or you are thinking of extending to group-based products? So that if enterprises can be able to run a joint business, do they have an opportunity to apply for a joint credit? And when they apply jointly, there's an effect of that lowering its risk profile. So thank you so much, and that's the presentation.